Moving on, we'll observe the long term, so long-term solvency ratios. In 2016, Viacom showed a whopping debt-to-equity ratio of 0.6133. When compared to the industry average of 0.04, this ratio should be a flag for investors. Throughout 2016, competitors in the streaming sector saw major growth, and consumers began a major shift away from traditional media consumption. Viacom needed to make a move against Netflix's global expansion, Hulu's partnerships with Disney and Showtime, both large competitors, and combat the movement of nearly 57% of the market to these new platforms. Viacom was investing in new content, which requires more funds. In 2016, the network saw MTV launch more than 10 new shows, and Paramount Pictures released 8 new movies. Major capital goes into those projects. However, this money does need to be paid back. And while 2017 showed a decrease to 0.4127 in the debt to equity, it is still above that industry average, and certainly something to watch, as a prolonged downward trend could cause issues for the company. Moving on to debt to assets for Viacom in 2016 and 2017 were 0.1549 and 0.1667, respectively. These numbers are lower than the pure risk average of 0.4. In this case, the lower number puts Viacom in a good position, as their amount of debt is significantly less than that of their assets, showing that the company does hold a number of useful and significant assets that can be used to offset debts. Finally, we measure the company's cash to liabilities ratio and see the company's steep drop off from 2016 to 2017. In 2016, Viacom's ratio was showing at a strong 68.85, whereas of 2017, Viacom has significantly dropped to 10.32%. This ratio shows how likely a company is to support their current debt load. A sharp drop and low ratio makes Viacom appear much more risky to investors looking for a company to cover its bases and pay its dividends.